Ever looked at a big company's earnings report and just wondered what's really going on behind those headlines? Today, we're taking a deep dive into Performance Food Group Company, PFGC, looking at their latest results from August 13th, 2025. And we're going to try and untangle this kind of fascinating puzzle. Booming sales? Yeah, but a dip in the reported profits. Is this some kind of strategic masterstroke for future growth, or, is there maybe a warning sign hidden in there?
Right. Our mission here is really to get beyond just the raw figures. We'll unpack what's driving their performance, try to understand the strategic choices they're making right now, and look at their path forward in this pretty dynamic food away from home market. You'll hopefully get those aha moments that show how companies navigate, well, growth, investment, and all that market volatility.
Okay, let's dissect this then. PFGC just wrapped up fiscal 2025, and their press release used terms like strong financial results. And yeah, on the surface, the top line numbers, they certainly look impressive. For the fourth quarter of fiscal 2025, net sales climbed, was it 11.5%, hitting $16.9 billion. And for the full year, sales up 8.6% to a really big $63.3 billion. We also saw total case volume, that's the actual amount of stuff they're moving, jump by 11.9% in Q4, 8.5% for the full year. Gross profit was up significantly too, 14.6% in Q4, 12.8% for the full year. So, I mean, volume, revenue, gross profit, it's all looking up.
Yeah, exactly. But what's truly fascinating here, and maybe the core puzzle we're exploring, is what happens when you dig a bit deeper into profitability. While those sales and gross profit figures show, really impressive top-line momentum, their gap that's generally accepted accounting principles, net income and diluted earnings per share, they actually decreased. For Q4, GAAP net income was down 21.0% to $131.5 million, diluted EPS down 21.5% to 0.04 cents, and the full-year numbers showed a similar trend, a noticeable dip.
That really does sound counterintuitive, right? How can sales and gross profit be up that much, yet the traditional net income, the EPS, it's down? For someone just glancing at the headlines, all that might raise an eyebrow.
Absolutely. And that's why it's so critical to understand the nuance here. See, the decrease in GAAP net income was primarily driven by higher depreciation, amortization, and interest expense. Think of it like this. PFGC has been making some pretty significant strategic investments, especially through recent big acquisitions like Cheney Brothers and Jose Santiago. When you acquire a company, well, you take on its assets, right? Those then get depreciated over time. And you often take on debt to fund those deals, which means higher interest expenses. These are, non-cash or financing costs that, while totally legitimate under GAAP, they don't really reflect the day-to-day operational efficiency of the core business itself.
Okay, so if the GAAP numbers are showing a dip because of these big sort of long-term strategic investments, how do they measure what's actually happening on the ground operationally?
Well, that's where their non-GAAP metrics come in. And the picture changes dramatically. These adjusted metrics like adjusted EBITDA and adjusted diluted EPS, they basically strip out those specific items we just talked about: depreciation, amortization, interest, other sort of one-time costs. It's designed to give you, the listener, a clearer view of the underlying operational performance, the profitability of their actual food distribution business. And on those metrics, the story is one of strong growth. Adjusted EBITDA for Q4, up 19.9% to $546.9 million. Adjusted diluted EPS rose 6.9% to $1.55. For the full year, adjusted EBITDA increased 17.3% to $1.8 billion, and adjusted diluted EPS was up 4.2% to $4.48. So this isn't just like some accounting trick. It reveals that while short-term GAAP profits might be hit by their expansion strategy, the company is clearly prioritizing long-term market capture and operational growth. It signals a patient, growth-oriented approach, which, can be a strong indicator for investors looking beyond just the quarterly headlines.
Right. So it sounds like despite these accounting impacts, the CEO, George Holm, he's confidently looking at those adjusted numbers. He highlighted contributions from all three segments, seemed proud of their, 43,000 employees driving market share gains. He even mentioned they're on track to achieve those ambitious three-year financial targets. That's a pretty strong vote of confidence in their current path, isn't it?
Absolutely. Yeah, the CEO's comments really underscore that this isn't seen as a problem to solve internally. It's more like a calculated cost of growth. They're investing in the future, and yeah, those investments show up in the GAAP numbers. But the operational core, it's clearly performing well.
That makes perfect sense. Now let's really dig into the details. Let's break down how each of PFG's three segments, food service, convenience, and specialty, actually contributed to these overall results. This is where we see the engines of their growth, right?
Right. So the food service segment, this was an absolute powerhouse for them, a really significant growth engine. In Q4, its net sales surged
an impressive 20.0% to $9.2 billion. And their adjusted EBITDA, that key measure of operational profit, was up a strong 26.3% to $386.9 million. Now, this isn't just about riding some market wave. It's fueled by those strategic acquisitions, yes, but also really robust organic growth. Their total independent case volume, which is crucial because independent restaurants often mean higher margins, that increased by a phenomenal 20.4%. And within that, organic independent case growth was a healthy 5.9% for the quarter, or 4.6% for the full year. This indicates they're really adding new customers and selling more to existing ones, even without those acquisitions factoring in.
That organic growth piece, that's really key, isn't it? It means their core business is expanding on its own steam, not just through M&A. And they also mentioned new account growth at 5.3%, plus strong performance in specific cuisine segments. What does that tell us about their market strategy?
Well, it tells us they're not just casting a wide net. They seem to be strategically targeting specific high-growth areas within that whole food away-from-home market. Mexican, Asian, pizza, Italian. These are clearly segments where they're finding success. It suggests a focused approach, maybe leveraging product lines or distribution tailored to those needs. It's quite a nuanced approach to growth. Okay, moving on to the convenience segment. Now, this is a market that's, well, consistently proven tougher overall, especially with shifts like remote work impacting commuter traffic and even broader things like the illicit vape issue affecting sales in some categories. But despite those headwinds, PFG actually managed to outperform. Q4 net sales increased 2.8% to $6.4 billion. And adjusted EBITDA was up 4.8% to $120.0 million.
So they're growing even when the industry around them is facing these headwinds. How do they manage positive case growth in all 4 quarters of fiscal 2025, especially when, as you said, the overall industry saw mid-single-digit declines in key categories? That really stands out.
It does, yeah. Their success here seems to boil down to 2 key strategies. First, aggressively winning new accounts. And second, expanding their food service offerings within the convenience channel. I mean, think about it. Gas stations, convenience stores, they're increasingly diversifying beyond just fuel and snacks, right? They're pushing prepared food, fresh stuff, coffee programs. PFG is clearly capitalizing on that trend, helping these stores grow their own food service capabilities. Oh, and they also benefited from inventory holding gains, which basically just means the value of the inventory they already had on hand went up. That helped their gross profit a bit, a strategic plus in an inflationary time. And finally, the specialty segment. This saw a nice rebound. For Q4, net sales increased 4.1% to $1.3 billion, and adjusted EBITDA grew 9.0% to $93.2 million. This growth wasn't tied to like one single big trend. It was pretty diversified, driven by expansion, vending, office coffee, value channels, and retail.
It seems like they're really diversifying their revenue streams there, even with smaller sort of niche channels. And they also highlighted their e-commerce platform. Still small, okay, but growing at a double-digit clip, that sounds like a smart long-term play laying groundwork.
Absolutely. That e-commerce growth, even though it's small compared to the overall numbers, it signals their investment in future channels meeting customers where they are. So if we connect all these dots, the key takeaway here for you, the listener, is that all 3 segments actually accelerated their growth in the final quarter of the year. This multi-segment strength, it isn't just momentum, it's really a testament to their diversified approach, and it positions them, I think, extremely well for fiscal 2026. They're not just reliant on one part of the business to pull the load.
That's a great overview of their past performance. Now let's shift gears a bit and look ahead to the future. What are they expecting for fiscal 2026? What's PFG's forward guidance telling us about their confidence and strategic priorities for the next year?
Okay, for the first quarter of fiscal 2026, which is actually underway now, they project net sales somewhere between $16.6 billion and $16.9 billion, with adjusted EBITDA between $465 million and $485 million. And for the full fiscal year 2026, they're anticipating net sales between $67 billion and $68 billion, and adjusted EBITDA between $1.9 billion and $2 billion.
Okay, if you compare that Q1 guidance to the very strong Q4 numbers we just discussed, it might seem a little lower than some might expect, or maybe even a slight deceleration. Why the moderation in the immediate outlook? Is that a red flag?
Not at all, actually. It's quite the opposite when you understand the context. The company gave very clear reasons for this, and it's a classic example of, well, growth investments impacting short-term numbers. First, those big acquisitions, Jose Santiago and Cheney Brothers. They're significant contributors now, but they're in their slower seasonal period during the summer months, which make up most of Q1. Food service usually dips a bit in summer. Second, And this is crucial, PFG is making heavy, calculated strategic investments right now. They finished fiscal 2025 with an 8.8% increase in food service sales reps, and they're continuing this aggressive hiring. That's a substantial investment in people.
So they're essentially adding fuel to the fire, maybe, but that fuel comes with an upfront cost that hits the near-term profitability.
Exactly. Think of the startup costs involved. Training, salaries, benefits. Getting new reps up to speed before they really start contributing fully to sales. And it goes further. There are significant startup costs tied to onboarding large new customer agreements in the convenience segment. Specifically, they mentioned bringing on over 1,000 new stores in Q2 and Q3 of fiscal 2026. Imagine the logistical effort, the initial investment needed to set up distribution for that many new places, train staff, optimize routes. These are effectively good problems to have, right? Investments aim squarely at securing long-term growth and market share, even if they moderate profit in the very short term. It's a strategic choice. Invest now for bigger returns later.
That contextualizes the numbers perfectly. Yeah, it's clear they're playing the long game here, and that long-term view, it extends to their capital allocation too, doesn't it? They invested, what, $506 million in capital expenditures in fiscal 2025? Mainly for growth projects like warehouse expansions, increasing their fleet. What does that signal?
It signals strong conviction in their organic growth path. Investing $500 million in CapEx, mostly on expanding physical infrastructure like warehouses and trucks. It means they're literally building out the capacity to handle more volume down the road. They're anticipating more sales, more customers, bigger deliveries. For fiscal 2026, they expect CapEx to be around 0.70% of net sales. That's a significant ongoing investment level. They also announced a new $500 million share repurchase program, though they did say they're prioritizing debt reduction right now. So it indicates a balanced approach, rewarding shareholders while keeping finances disciplined.
And what about mergers and acquisitions, M&A? Is that still a big part of their growth story moving forward, or are they really shifting focus more to organic growth now?
Well, their M&A pipeline is apparently robust. They've mentioned some actionable opportunities, but nothing significant in size at the moment, according to them. And this lines up with their stated strategy. They're very selective with acquisitions. They prefer deals where they can retain and grow all the acquired business rather than just sort of fold-in models, which means they're looking for strategic fits that truly enhance their capabilities or market reach, not just buying revenue and consolidating. So, yeah, they're clearly betting heavily on organic growth too, especially in areas like the West Coast. They mentioned investing in new redistribution facilities there, strengthening their brands. It looked like a combo of strategic M&A and really doubling down on internal growth drivers.
Okay, let's broaden our view then. Beyond just PFG, let's zoom out to the overall food away from home industry. What are the macro trends, and how is PFG navigating these broader currents?
So the industry backdrop is still what PFG describes as a volatile market and not quite operating at a level we would like. But, and this is key, it is showing definite signs of improvement. Restaurant foot traffic, for instance, that improved month by month in Q4. And July was actually the first positive month they'd seen.
Yeah.
It's a pretty significant milestone, psychologically and economically. They see mixed results across different customer segments. Higher-priced quick service places still doing well. And crucially, casual dining and family dining venues seem to be coming back as consumers maybe look to get out again, which suggests a shift in behavior back towards dining experiences. Interestingly, they're seeing less growth in takeout. Delivery remains strong, but it's not rapidly expanding either. So it paints a picture of people returning to actual restaurant locations.
And how about that convenience segment, which, as you said, sounds like it faces its own unique set of challenges compared to traditional food service. What are the specific headwinds there?
Yeah, the convenience industry continues to be, in their words, consistently difficult. It's influenced by broad trends, like remote work, hitting commuter traffic, which directly impacts store visits, and even very specific things like what they call the illicit vape issue that can impact category sales. The morning day part, traditionally strong for coffee and breakfast. That remains pressured. Coffee sales are still below 2019 levels, apparently. So yeah, it's a tough environment. However, and this is where PFG's strategic execution really seems to shine their sign. Convenience segment is actively gaining market share, consistently outperforming the broader industry.
So right, despite all those external challenges, PFG isn't just treading water, they're actually gaining ground. What do they attribute that outperformance to? What's their secret sauce in such a competitive, challenging market?
It seems to come down to a few key operational and strategic levers. They attribute it to aggressively pursuing new business, especially focusing on those higher margin independent accounts within the convenience space. They're driving procurement efficiencies, basically getting better deals on the products they buy, which helps gross profit. And they're maintaining operational expense leverage across all segments, which means managing costs effectively as sales volume grows. They also feel pretty confident in their ability to manage price swings and inflation, which they're modeling at low to mid-single digits for fiscal 2026. That confidence suggests they have effective pricing power and robust supply chain management. So for you, the listener, this means PFTC isn't just surviving these tough conditions. They seem to be actively seizing opportunities even when things are difficult.
Okay, so to recap then, PFG finished fiscal 2025 strong, powered by strategic acquisitions, boosting the top line, sure, but also, crucially, by impressive organic growth across all three segments. That shows their core business is really thriving. They're making significant, very intentional investments in their sales force and infrastructure. And these investments, while, yeah, they're temporarily impacting GAAP profitability in the short term, they are clearly setting the stage for what PFG projects will be a new high for results in fiscal 2026. It's a deliberate strategy, seems like, to build capacity and market share for the long haul.
Right. And maybe a final thought for you to chew on. Given PFG's dual focus here, accelerating that organic growth and carefully evaluating acquisitions, how might a continued, even if slow, industry recovery, or maybe even further consolidation in the broader food service distribution market, how might that impact their ambitious 3-year financial targets? And as the industry navigates these evolving consumer behaviors, what other strategic levers might PFG pull? Things beyond what we've discussed today, maybe, to maintain their momentum and really differentiate themselves in the years ahead. Will their current investment strategy allow them to not just keep pace, but actually lead the next wave of industry transformation?
Something to think about as you go about your day. Thanks for joining us for this deep dive into Performance Food Group Company's latest earnings.